That's right. Usually, a rising gold price is the canary in the coal
Hmm.
mine for price rises coming. I mean, if you remember in 2020, gold dropped in March from like 1700 to 1450, and then it took off to 2000
Yeah.
in early 2020, 2021. And then we saw the prices rising, like the CPI. Right now, the CPI is kind of under control, but a lot of that currency and credit is flowing into financial assets for now. But when people take profit or whatever and start spending, it could flow back into the consumer price index.
The US economy, despite outward signs of stability, is moving toward another inflection point, one that could mirror the dramatic shifts of 2020, but with even broader consequences. As Mario Innecco points out, a rising gold price has historically acted as the canary in the coal mine, warning of future consumer price surges. Back in early 2020, gold initially dropped sharply before rallying to $2,000, foreshadowing the inflationary wave that would grip global economies. Today, we see a similar pattern. Gold is quietly firming while the official CPI remains relatively contained. But beneath the surface, vast amounts of liquidity and credit are being funneled into financial markets. The moment this capital rotates into the real economy, through consumer spending or flight from equities, the consequences could be swift and inflationary. Adding to this pressure is an escalating geopolitical backdrop. Innecco references reports from Switzerland indicating that Russia was recently forced to cancel a major naval event in St. Petersburg, due to drone threats. The suspected origin of these attacks, from deep within Ukraine, raises serious strategic questions, chiefly whether NATO may be edging closer to direct confrontation with Moscow. This is no longer about territorial disputes. It's about existential positioning in a multipolar world, and the stakes are rising. While most analysts focus on sanctions and commodity flows, the unspoken truth is that in times of global turbulence, nations holding strategic reserves of physical gold and silver, like Russia, are better equipped to weather systemic shocks. Russia's posture in this monetary chess game is built on more than just its commodities dominance. According to Innecco, the Kremlin has quietly amassed gold not for speculative purposes, but as a deliberate hedge against the fragility of the Western financial system. Following the seizure of its foreign reserves in 2022, Russia accelerated its de-dollarization efforts, pivoting toward bilateral trade, local currencies, and hard assets. Gold in this context is not a hedge, it's insurance. It cannot be frozen, sanctioned, or digitally disabled. If the brewing standoff between NATO and Russia were to escalate further, expect not just a geopolitical shock, but a massive reallocation into safe haven assets. And with silver's growing strategic importance in industrial and military applications, it won't be far behind. Now, as we transition from macro threats into historical cycles, it's essential to understand how this moment fits into a broader global reset. So let's explore what Mario Innecco and others mean when they speak of the fourth turning and its economic implications. But before we do, don't forget to like, share, and subscribe to stay ahead of the curve with facts and real analysis on the markets and the macro shifts that shape them. We appreciate the support and hope you enjoy the video.
Yeah, I mean, the economic monetary situation hasn't changed. We've seen M2 in the US make new all-time highs. So in my book, that's monetary inflation. It's going to continue. We've got the Fed meeting starting tomorrow and ending on Wednesday. Markets don't expect anything from the Fed, but you never know. The fact that Trump has done a deal with the EU and is postponed the tariff implementation for the Chinese tariffs for 90 months. That might make the Fed a bit more comfortable in cutting rates. The other thing, Denny, that I haven't really been looking at too much, and that's more the geopolitical aspect. And probably because here in the UK, they've censored a lot of stuff since the Ukraine war started. For example, where we don't have access to RT anymore, RT news in Russia. But someone in Switzerland today told me that they have access there to RT. And apparently yesterday, President Putin or the Russians, they had to cancel a naval exhibition in St. Petersburg because of a threat of drone attacks, or there were drone attacks. Apparently, they came from Ukraine, but apparently, coming from the Ukraine would be really difficult to go all that distance to the Baltic, because St. Petersburg is in the Baltic. So this friend of mine thinks they're provoking Putin and that it's NATO. So I think that's really serious, and we're not hearing much about this, not even in the alternative media in the West. And why is that important? Well, because it could lead to some kind of confrontation between NATO and Russia, and that would be very serious. And you want to have gold and silver, especially in that situation. It's not why I have been stacking gold and silver, but it makes it even more necessary, I think.
Initially, President Trump laid out a 50-day ultimatum for Russia. However, given recent comments, he's signaled that he's going to bring that down to, I believe, 12 days now. Why do you think he's made a radical shift in his policy?
Difficult to say, but I can only speculate. Maybe it's got something to do with some of these files, and maybe it's the deep state. They're playing against each other. Trump is saying, yeah, I won't release this, and but then they say, well, if you do this and that, maybe the deep state is behind it, because it makes no sense that he's reversing everything. It's a little bit like the economic situation, or the market situation, just around April time, when the market started tanking. We would hear Bessent or Trump saying, well, this is necessary. We've had a huge bubble. We can't just focus on the stock market. And then when it got really bad, the whole focus is now in the stock market. So yeah, I think he's got a lot of pressure from people behind the scenes, people who probably donated a lot to him. So he's like changing his tack.
In what way could Russia stand to benefit from a higher gold and silver price?
I don't think they care much for the price, even though it helps. And I don't think that's what they're trying to do, the Russians. But they do hold a lot of physical gold, not just like underground reserves, and the fact that Russia is one of the biggest gold producers in the world. And it's also a huge commodity country. But yeah, I think they hold it more as a strategic monetary asset that you can depend on times of uncertainty, especially after 2022, when their fiat reserves were frozen, and they're still frozen from my understanding. But gold is it's nobody's liability, and if you hold it at home, you can do anything you want. You can trade with any country. It's recognized the world over. And I haven't seen Trump or the Treasury talk about sanctioning gold. You can't really sanction gold. So, but I also, yeah, that deadline is serious, isn't it? Because it could backfire, because China would be impacted by that. China, Iran, and other countries that buy oil from Russia. So yeah, it's all getting very uncertain, and that's the way the world is right now. And I think Greenspan, I have the book on my shelf back here. He wrote a book 11 years ago, The Age of Turbulence. And he kind of forecast this scenario. And I think we are in the age of turbulence. I guess, like you said earlier, it corresponds with the fourth turning.
The fourth turning, A generational theory popularized by Strauss and Howe posits that every 80 to 100 years, societies experience a climactic period of upheaval, where old institutions collapse and a new societal framework emerges. According to Innecco, we are now in the final stages of this turbulent cycle. These cycles are marked by war, economic realignment, political crisis, and ultimately, the formation of a new global order. For those watching the dollar, gold, and geopolitical dynamics, the pattern is unmistakable. The post-Bretton Woods fiat system is fracturing under the strain of unsustainable debt, political dysfunction, and a monetary policy apparatus that has become a tool of statecraft rather than economic stewardship. Innecco emphasizes that monetary inflation is not just persisting, it's accelerating. M2 money supply has reached new all-time highs in the US, even as the Federal Reserve publicly hesitates to cut interest rates. Meanwhile, geopolitical risks, from trade tariffs to Eastern European instability, further complicate central bank policy. With Trump reportedly deferring tariffs on Chinese goods and threatening tighter timelines on Russia, the Fed finds itself trapped between political agendas and market realities. The result is a policy paralysis that only deepens systemic fragility. In this context, gold and silver aren't merely hedges, they're escape valves for capital seeking refuge from failing institutions. That brings us back to the metals markets, specifically the performance trajectory of silver, platinum, and gold from here. Let's get back to Mario Innecco's video.
Which one do you anticipate outperforms from here?
I think silver, silver outperforms, and then platinum, and then gold. But as I tell my viewers, because they ask, should I sell silver to buy gold? And I say, if you want, but I try to just get rid of spare fiat to buy both. But I guess you could buy more silver now than gold, or you could go through the mining space as well to leverage. If you're into that kind of stuff, there's the silver miners as well.
Yeah, so silver, platinum, and then gold. And taking it back to what you initially brought up at the start of the show, talking about interest rates and some of the back and forth between President Trump and Chairman Powell and Secretary Bessent. There doesn't appear to be any predictions or certainty or confidence that they will cut rates this week, this coming Wednesday. But why is that? Why do you think there's a split between President Trump and the Fed? And if they do cut rates, will that be enough to get what they need, i.e. easier to get the economy moving? Considering that the last time they did cut rates, we've seen about a 100 basis point cut over the last year and a half or so. And you look at the 10-year, 10-year actually moved opposite to the cuts.
Yeah, and so have mortgage rates. And I think Bessent and Trump mentioned that they want to see the mortgage market get kick-started, because what's happening is people who have long-term mortgages, they locked in during COVID at very low rates. They don't want to sell their homes because they would have to refinance at a much higher rate. So the real estate market is kind of moribund. And but like you said, they started cutting rates September last year. They cut by a total of 100, and the 10-year yield has gone from 3.6 to 4.4. So I think that's what the Fed is concerned about. They're concerned that if they cut too aggressively in the short end, you're gonna see the longer end rally quite a bit. It's going to affect their balance sheet because they hold a lot of treasuries. They're already sitting on hundreds of billions of losses. And it would actually backfire for the Treasury. The cost of financing interest payments would rise. But I would think Besant would understand that, having been on Wall Street as a hedge fund manager for so many years. I can understand why Trump doesn't understand that. He's not really a bond person. He's a real estate developer. So yeah, I think that's why there is division, and it doesn't make sense either to cut rates right now. You showed that chart of M2 making all-time highs. That's just gonna fuel the growth of M2. We've got the stock market near all-time highs. I mean, the Buffett indicator, market cap of all US stocks to GDP is at all-time highs. I mean, do you really need to cut rates? It would, I mean, for us precious metals enthusiasts, that would be really, really good. And I think they might, because the technical picture is pointing to continued move higher, I think, in silver and gold.
Is that why they stopped cutting rates? They cut it short at 100 because they did see the 10-year yield begin to spike?
Partly, I guess. I think they haven't told us that. Maybe I haven't really combed through all the minutes of the FOMC, but one of the major reasons is that the uncertainty surrounding the tariff program of President Trump, because it does raise prices. Tariffs. It's not the foreigners that pay the tariffs. It's the importing company in the U.S., and they pass it on to the wholesaler, retailer, and the consumer. Yeah, so that's a kind of rising prices, and that could lead to higher prices elsewhere, and that's what the Fed is concerned about. They say they're concerned about inflation, but technically they're concerned about prices, because it's the Fed that really creates the inflation. But so they can't create the inflation right now because, yeah, the prices are going to be affected by the tariffs. But it hasn't been, these tariffs and the prices haven't been around that long. Need maybe at least 6 months to see what happens. So I think that's why the Fed's been waiting. Yeah. Or some people could argue that they're being political, even though it was Trump who nominated Powell as the chairman of the Federal Reserve. Yeah, that's right. Usually a rising gold price is the canary in the coal mine for price rises coming. I mean, if you remember in 2020, gold dropped in March from like 1,700 to 1,450, and then it took off to 2,000.
Yeah.
In early 2020, 2021. And then we saw the prices rising, like the CPI. Right now, the CPI is kind of under control, but a lot of that currency and credit is flowing into financial assets for now. But when people take profit or whatever and start spending, it could flow back into the consumer price.
Mario Innecco makes a strong case for silver as the metal most likely to outperform in the near term. Its industrial utility, monetary legacy, and relatively undervalued position compared to gold make it an attractive asset. While many investors debate whether to switch from silver to gold or vice versa, Innecco advocates a more pragmatic approach: convert excess fiat into both, and where appropriate, explore leverage through mining equities. The silver miners in particular could offer asymmetric returns in a bull cycle driven by both monetary hedging and renewed industrial demand. The Federal Reserve's policy calculus is no longer just about employment and inflation targets. It's increasingly about managing fiscal sustainability and political fallout. As Innecco notes, despite a full 100 basis points of rate cuts since last September, yields on the 10-year Treasury have actually risen. Mortgage rates remain elevated, stalling the housing market and locking homeowners into ultra-low COVID-era rates. This creates a stagnant, illiquid housing environment with broader implications for consumer mobility and credit markets. Cutting rates further risks steepening the yield curve in the wrong direction, hurting the Fed's balance sheet, increasing Treasury interest burdens, and destabilizing the bond market. Meanwhile, the political divide between President Trump, Fed Chair Powell, and Treasury Secretary Bent is beginning to surface publicly. Trump and Bent appear eager to reignite housing and consumption, but Powell, facing the mathematical constraints of M2 growth and a richly valued stock market, knows rate cuts could backfire spectacularly. The Fed is not just battling inflation optics, it is trying to maintain systemic credibility while juggling a deeply politicized mandate. And as Innecco underscores, the real fear isn't inflation, it's price instability. With tariffs poised to raise import costs and the possibility of renewed war premiums on commodities, the Fed's toolkit looks increasingly blunt. The bottom line? Gold and silver are no longer peripheral hedges. They're becoming foundational assets in a world tilting toward monetary fragmentation. Whether it's a NATO-Russia standoff, a fourth turning climax, or fiscal dysfunction in Washington, these metals are positioned to benefit from the breakdown of traditional financial and political frameworks. Investors would be wise to understand not just the charts and ratios, but the tectonic shifts beneath the surface. If you found this analysis insightful, don't forget to subscribe and share. Let us know in the comments how you're positioning in this cycle. Are you leaning into silver, gold, or playing the mining equities? Stay informed, stay strategic, and stay tuned for more grounded market intelligence.